Hey everyone, welcome back to Corporate Decoder, the place where we make sense of the corporate world. And today we're digging into Farmers National Bank Corp. Its latest quarterly report. Folks, this filing is packed tighter than a rush hour elevator, but we're going to decode it and see what Farmers is really up to. Now, if you like getting the real story behind these dense documents, make sure you are subscribed and ring that notification bell. And hey, we've got a fantastic community over on Discord to continue the conversation. Link in the description below. Let's jump right into the numbers and see how this bank is performing. Looking at their balance sheet at the end of September 2025, total assets stand at a pretty massive $5.2 billion. That's up slightly from December 2024. Now, what stands out here? Deposits are a huge chunk of their business, totaling over $4.4 billion. That is a good sign that people trust them with their money. But where does that money go? Well, overwhelmingly into loans. Net loans are sitting at just under $3.3 billion. That's their core business, and it's grown a bit since last year. What is interesting is that this massive loan book is financed largely by deposits. Their loans compared to deposits ratio is around 75%. That is a healthy ratio, meaning they have plenty of deposit money to back their loans without relying too heavily on other, potentially more expensive funding. Now, with all those loans, there is always a risk that some borrowers won't pay them back. That is where the allowance for credit losses comes in. It is like a rainy day fund for bad loans. At the 30th of September 2025, this fund stood at about $39.5 million. This is up from $35.9 million at the end of 2024, suggesting they're being a bit more cautious, or perhaps seeing some signs of strain in certain loan portfolios. Let's move over to the income statement for the third quarter of 2025. Farmers reported a net income of $12.5 million. That's a pretty decent jump from about $8.5 million in the same quarter last year. This translates to diluted earnings per S-share of 33 cents, up from 23 cents in the prior year's third quarter. So, on the surface, things look like they're improving. Their 9-month net income is also up to about $39.9 million from $31.6 million in 2024. A lot of that profit comes from their core banking operations. Net interest income, which is the difference between what they earn on loans and investments and what they pay on deposits and borrowings, increased to $36.3 million for the quarter. This is a good sign, especially as their net interest margin, a key measure of profitability, improved. Their net interest margin hit 3.00% for the quarter, up from 2.66% last year. This tells us they're earning more on their assets relative to their liabilities. But they're not just a one-trick pony non-interest income, which includes fees from various services, brought in $11.4 million for the quarter. Things like trust fees, insurance agency commissions, and retirement plan consulting all add to the bottom line. Trust fees alone are nearly $2.7 million for the quarter, showing a strong performance in that segment. Of course, running a bank isn't cheap. Non-interest expenses, which cover things like salaries, rent, and technology, were about $31.7 million for the quarter. This is up from about $27.1 million in the same quarter last year. A significant chunk of that increase, about $3.1 million, is linked to consulting costs for a new core platform. They believe this will save them money in the long run, but it is a notable expense for now. Now, about those securities available for sale, the report shows an amortized cost of nearly $1.5 billion on the 30th of September 2025. But here is a critical detail, folks. The fair value of these securities is actually lower, standing at about $1.3 billion. That is a difference of about $200 million in unrealized losses. They attribute this mostly to changes in interest rates, not credit quality, which is good, but it still represents a significant paper loss. A large portion of these securities are US Treasuries and government-backed entities, which are generally considered very safe. However, they also hold significant amounts in state and political subdivisions and mortgage-backed securities where those unrealized losses are more pronounced. Let's look at the loan portfolio breakdown. Commercial real estate is their largest segment, totaling over $1.6 billion. Within that, retail properties make up about 21% of this segment, followed by warehouse and industrial at 13.8% and office at nearly 12%. It is important to note that their office loan portfolio, while not the largest, has a weighted average occupancy rate of just under 60% as of September 2025. This, along with the declining farmland sector, could be areas to watch. When it comes to valuing assets, especially those that aren't traded on a daily basis, things get a bit more subjective. Their level 3 assets, which rely on the most unobservable inputs, amount to about $958,000 for investment securities. For individually evaluated loans, their level 3 assets are nearly $14 million. Mainly in commercial real estate non-owner occupied properties. This means management's judgment plays a big role in valuing a portion of their holdings. Now, here is a significant piece of news that just happened. On the 20th of October 2025, Farmers announced they're merging with Middlefield Bank Corp. This is an all-stock deal valued at roughly $299 million. They expect to close this in the first quarter of 2026. This move aims to expand their market. And while mergers can bring benefits, they also come with integration challenges and costs. Looking at the broader picture, Farmers, like all financial institutions, faces considerable risks. They highlight changes in governmental policies, economic conditions, and interest rate volatility as major concerns. The recent One Big Beautiful Bill Act is mentioned, though they don't expect it to have a material impact. However, the unpredictability of policy shifts remains a significant factor. They also detail the risks associated with this Middlefield merger. Integrating two companies is never easy. There is the potential for disruption, difficulty retaining key employees, and the possibility that the anticipated benefits and cost savings might not materialize as planned. This is a crucial point to watch as the integration unfolds. So what is the verdict on Farmers National Bank Corp? Their core banking business appears solid, with improving net interest margins and healthy deposit growth financing their loan book. The acquisition of Crest Retirement Advisors, LLC, and the upcoming merger with Middlefield Bank Corp signal an ambition for growth, both through expanding their fee-based services and consolidating their market position. However, the unrealized losses in their securities portfolio, the slight dip in collateralization for some commercial real estate loans, and the inherent risks of integration in the Middlefield merger are definitely areas that warrant attention. They're navigating a complex economic landscape with shifting interest rates and regulatory changes. And as always, prudent management and adaptability will be key. Alright, that's our breakdown of Farmers National Bank Corp. Its latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments below if this analysis was valuable. Hitting that like button really helps us out, and of course subscribe for more deep dives into financial reports. And don't forget to join the conversation over on our Discord channel, link in the description. Thanks for watching, and we'll see you in the next video.